Welcome to the deep dive. Today we're taking a really close look at something impacting millions of financial lives, especially in India: systematic investment plans. You know,
Yeah.
SIPs. We're using insights from this pretty interesting article, Behavior Edge Test Cricket and SIP, specifically asking, are you doing what millions in India are? And, maybe more importantly, can you get an edge with just a small behavioral tweak?
Right.
Our mission today is really to unpack why so many SIPs might be, well, underperforming their potential, and how a simple shift can really change your financial game.
And it's fascinating, isn't it, just how huge SIPs have become in India. It's really
Yeah.
fostered this goal-based investing culture.
Yeah.
So we'll look at the current scene, pinpoint a common, maybe surprising pitfall, and then tie it all together with a great analogy that really clarifies the path to better financial freedom.
Okay, let's get into those numbers then, because they are pretty staggering. We're looking at, what, around 84 million active SIP accounts in India. This was as of April 2025.
That's right, 84 million. It's not just some niche thing, it's a massive movement.
Absolutely huge.
Yeah, and think about this. The average retail investor is putting in about $3,200 a month.
Okay.
Cumulatively, that adds up to something like 26,000 crores every single month.
Wow.
And that's mostly going into equity-oriented schemes. So funds investing mainly in stocks.
Right.
So it's not just saving, it's millions of people actively working towards financial goals in a planned way. We've seen steady growth too, up from 64 million accounts just a year earlier in April 2024.
That growth trajectory is incredible.
It really shows a shift in India's investment culture.
Okay, so that's the big picture. But here's where it gets really interesting, maybe a bit counterintuitive. Despite this fantastic, systematic behavior, the article points out this small lacuna, they call it, a gap.
Oh, yeah.
It's preventing investors from getting the full benefit. Basically, many CPE investors are stopping right before their money really starts working hard for them, like quitting a race just before the finish line.
Exactly. It really raises the question, doesn't it? Why stop short?
Yeah, why?
Well, the article suggests most SIPs are registered for maybe 2 to 3 years, max.
That's short, really.
Yeah. But for equities, for stocks, you typically need more like a 5 to 10-year horizon for them to, work wonders,
Right.
as the article puts it.
Makes sense.
So this short time frame means investors just don't get the full power of compounding. That snowball effect, earning returns on your returns, it gets cut short.
And the data backs this up pretty dramatically.
Right.
Get this. Only 1 in 4 SIPs in India stays active for more than 3 years.
Only 1 in 4. That's quite a statistic.
It really is. And the breakdown is even more telling. 45% are active for less than a year.
Almost half.
Wow. Yeah. Then 20% for 1 to 2 years, 10% for 2 to 3 years, then it really drops off. 8% for 3 to 4, 4% for 4 to 5, and only 12% make it past 5 years.
So the vast majority are stopping relatively early in the potential life cycle of an equity investment.
Exactly. A huge behavioral hurdle.
And if you look bigger picture, the net new SIP additions have actually turned negative recently.
Negative, meaning more are stopping than starting.
Well, yeah. Or maturing and not renewing. Each month over the last year, something like 3 to 4 million SIP accounts have either matured or been stopped early.
3 to 4 million a month.
Yeah, and that number's actually climbed a bit with market volatility. Now, sure, some of those are renewals, people starting again.
Yeah.
But it's clear that a significant majority, especially those whose SIPs mature in under 3 years, they just don't renew them promptly. They're getting out just as things could potentially take off, missing that exponential growth phase.
That's quite sobering data. It really begs the question then, if so many are falling short, how can you, the listener, actually get an edge?
Right.
And the article offers this fantastic analogy, maybe unexpected, but brilliant. It involves test cricket.
Yes, test cricket. It's not just about hitting boundaries, is it? It's about endurance, strategy, playing the long game.
Okay, how does that relate to SIPs?
So think of it like this. A test match lasts 5 days, broken into maybe 15 sessions. A captain wants to dominate, say, 5 or 6 of those sessions to win the match.
Right.
The analogy maps quite neatly. Each session is like 1 year of your SIP. Each day of play is like a 3-year block of your SIP. And the whole match, that's your 15-year investment horizon. And winning the match means hitting your target amount, your corpus.
Okay, let's make that concrete. Maybe an example.
Sure. Let's imagine you invest 25,000 euro every month via SIP. You're putting it in an equity fund, hoping for maybe a 10% average annual return over 15 years. Your goal is 1 crore.
Okay, 25K a month, 10% return, aiming for a core in 15 years.
Exactly. Now, here's the really cool insight and where it differs from cricket. Winning the sessions, or rather accumulating wealth, actually gets easier over time.
Easier? How so?
Because of compounding. So after 3 years, that's day 1 of the match, you might only have accumulated about 10% of your 1 crore target.
Only 10% after 3 years. Feels slow.
It can feel slow initially. After 6 years, day 2, maybe you're at 24%. Still feels like a long way off.
Right.
But then things accelerate. By the end of the 15 years, you could hit that 100% target. It's not linear growth. It ramps up. It's about staying in, patiently building that score.
Okay, that hypothetical makes sense. But does it hold up in the real world with actual market ups and downs?
Great question. Let's look at a real example. Imagine someone started a 15-year SIP right at the market peak in January 2008. Talk about bad timing, right?
Yeah, 2008, that was rough.
Exactly. Let's say they invested in the Nifty 500 TRI. That's a broad index representing the Indian market, including dividends.
Okay.
So the first 3 years, our day 1, returns were actually negative, minus 1.5% CAGR.
Oh.
And the next 3 years, day 2, still pretty flat, just 1% CAGR. So after 6 whole years, their returns were pretty disappointing, below average.
So far, this isn't sounding great for the long-term argument.
But wait. From year 7 through to year 15, the market behaved more like you'd expect, or even better. It delivered strong CAGRs, somewhere between 13.6% and 17.5% in those later blocks.
Okay, so it picked up significantly later on.
Exactly. And despite that really challenging start, the investor actually did very well overall.
Really? How well?
Well, remember, after day 1, 3 years, they only had about 10% of their target. By the end of day 3, 9 years, they were at 33%. Still seems like a climb.
Still a long way to go.
But here's the kicker. The next 6 years, days 4 and 5, that's where they accumulated a massive 67% of their final target amount.
Wow, 2/3 of the goal in the last 6 years.
Yes, and the total corpus almost doubled in just the last 3 years of that 15-year period.
Incredible. So what were the final numbers?
By the end of the 15 years, their total investment of 45 lakhs had potentially grown to about 134.2 lakhs.
So significantly more than the initial investment, despite starting at a market peak and having poor early returns.
Precisely. It's a powerful illustration that the biggest chunk of your wealth often gets built in the later years of a long-term SIP, all thanks to compounding.
Let me just recap that specific point because it's striking. In the first 3 years, they accumulated about 10% of the final amount.
Right.
But in the last 3 years alone, they accumulated roughly 33% of the final amount.
Exactly. It just highlights that while, no investment is guaranteed, sticking with a disciplined SIP program dramatically increases your odds of winning against market volatility over the long run. You have to stay in the game for that cumulative effect to really show up.
Okay, so staying invested longer, playing that test match is clearly crucial. But is that it? Just wait it out? Or are there other things you can do to make your SIP program even more robust, more reliable?
That's a great point. It's not just about endurance. You can refine your technique, so to speak.
Okay.
Beyond just staying the course, there are other strategies. Diversification is key, spreading your investments across different types of assets or funds within equities. Don't put all your eggs in one basket.
Makes sense. What else?
Then there's the idea of maybe booking profits at regular intervals, or more broadly, rebalancing your whole portfolio periodically. This helps you lock in some gains and keeps your risk level where you want it.
Okay, rebalancing. And what about when the market takes a dip? People get nervous then.
Right, and that's actually an opportunity, potentially. Another strategy is topping up your SIP, adding extra money during market phases when things look undervalued, or during drawdowns.
So buying more when prices are lower seems counterintuitive when everyone's panicking.
It does, but it can significantly boost your long-term returns when the market recovers. These are all, common strategies, maybe small tweaks, but they add layers of robustness to your plan. They help you navigate the inevitable ups and downs more effectively.
That makes a lot of sense. But managing all that diversification, rebalancing, knowing when to top up that can feel a bit daunting for an individual investor?
It certainly can. And the article actually touches on another interesting behavioral point related to this. Yeah, it hints at maybe getting some guidance helps people stick to these good behaviors.
You mean like using a financial advisor?
Exactly. The data seems to suggest that investors who use professional advisors, often through what are called regular plans, tend to stick with their investments longer.
Huh. Is there data on that?
There is. For SIPs that are active for more than 3 years, about 18% of the total registered accounts are regular plans with advisors. Compare that to only 6% for direct plans, where people manage it themselves.
So a significantly higher percentage of longer-term SIPs are advised.
Yeah. Now, the overall numbers for long-term SIPs, advised or not, still need to improve, as we discussed. But it does suggest that having that professional guidance might help investors stay the course, cut through the market noise, manage those behavioral biases we all have, and ultimately reach their goals perhaps a bit faster or more reliably.
Interesting. So whether you're just starting your investment journey or maybe rethinking your current approach, the core message from this deep dive seems clear. That relatively small behavioral tweak, committing to staying invested for the long haul, understanding that test match analogy, that could be your single biggest winning strategy.
Absolutely. It's about discipline and time.
Which leads us to maybe a final thought for you, our listener, to chew on.
Okay.
If we accept that the real magic of compounding, that powerful growth engine, truly kicks in during the later years of an investment,
Yeah.
how might shifting your focus, moving away from worrying about short-term market swings and instead focusing squarely on your long-term financial goals, how might that change the way you approach all your financial decisions, not just your SIPs? Something to think about.